Remember the 2008 financial crisis? The stock market plummeted, homes were lost, and retirement accounts vanished. It was a time of widespread panic and uncertainty, affecting millions of lives across the globe. Now, imagine a scenario potentially even worse. A situation where the financial systems we rely on are even more fragile. Experts are warning of another market crash, one that could be more devastating than what we experienced in 2008. This potential crash could dwarf the events of 2008, leading to even greater economic turmoil. The warning signs are flashing red, signaling that we need to pay attention and take action. It's crucial to be prepared for any financial eventuality. Understanding the risks and having a plan can make all the difference. Don't panic, but don't ignore the potential danger. Stay informed and make calculated decisions. Your financial well-being could depend on taking action now. Consult with financial advisors and review your investment strategies. Imagine this. You've worked hard, saved diligently, and invested wisely. You've built a nest egg for your future. Then, almost overnight, the market takes a nosedive. Your portfolio shrinks and your hard-earned savings are at risk. Your dreams of a comfortable retirement seem distant and fear sets in. The uncertainty can be overwhelming. This is the harsh reality a market crash can bring. Businesses close, jobs are lost, and financial security is threatened. But it doesn't have to be your story. By taking proactive measures, you can safeguard your financial future. By understanding the risks and taking proactive steps, you can protect your investments and weather the storm. Stay calm, stay informed, and take action. With the right approach, you can navigate through any financial crisis and emerge stronger. When it comes to navigating the treacherous waters of the stock market, there's perhaps no wiser captain than Warren Buffett. His strategies and insights have stood the test of time, guiding countless investors through both calm and stormy seas. Known as the Oracle of Omaha, Buffett has a legendary track record of success, built on a foundation of patience, discipline, and value investing. His approach is methodical and deeply rooted in fundamental analysis. Buffett's philosophy emphasizes the importance of understanding the intrinsic value of a company, rather than being swayed by market trends or short-term fluctuations. His insights have guided generations of investors, and his advice remains as relevant today as ever. Whether you're a novice or a seasoned investor, there's always something to learn from Buffett's wisdom. Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." This mantra has become a cornerstone of his investment strategy. This simple yet profound statement encapsulates his contrarian approach to investing. It encourages investors to think independently and avoid the herd mentality. When markets are euphoric, it's easy to get caught up in the frenzy and make irrational decisions. This is when caution and due diligence are most crucial. Conversely, when panic sets in, opportunities arise for those who remain calm and rational. Buffett's approach teaches us to look for value where others see only fear. Buffett's wisdom extends beyond market timing. He emphasizes the importance of a long-term perspective and the power of compound interest. He emphasizes the importance of investing in quality companies with strong fundamentals, understanding your risk tolerance, and avoiding emotional decision-making. These principles are the bedrock of successful investing. Understanding your risk tolerance and maintaining a disciplined approach can help you navigate the ups and downs of the market. His principles provide a roadmap for navigating market volatility and emerging stronger on the other side. By following Buffett's timeless wisdom, investors can build a resilient and prosperous financial future. While predicting the future is impossible, several warning signs suggest a market correction is on the horizon. Interest rates are rising, inflation remains stubbornly high, and geopolitical uncertainty is adding fuel to the fire. These factors create a volatile cocktail that could trigger a significant market downturn. One of the most concerning indicators is the disconnect between stock prices and underlying economic fundamentals. Despite rising inflation and slowing economic growth, the stock market has remained relatively buoyant. This disconnect, often referred to as a bubble, cannot last indefinitely. Another red flag is the increasing levels of debt across all sectors of the economy. From corporations to individuals, debt burdens are at historic highs. This mountain of debt makes the economy more vulnerable to shocks and could exacerbate a market downturn. The global economy is facing a confluence of challenges that could create the perfect storm for a market crash. The ongoing war in Ukraine, supply chain disruptions, and rising energy prices have all contributed to a surge in inflation, forcing central banks to raise interest rates aggressively. Higher interest rates make it more expensive for businesses to borrow money, potentially slowing economic growth. This can lead to a decline in corporate profits, which could trigger a sell-off in the stock market. Additionally, rising rates make bonds more attractive to investors, potentially drawing capital away from equities. The combination of geopolitical uncertainty, inflationary pressures, and rising interest rates has created a highly uncertain economic environment. This uncertainty is fueling market volatility and increasing the likelihood of a significant correction. Section 5. Weathering the Storm: Warren Buffett's Investment Strategies. So, how can you protect your investments in this uncertain environment? The financial landscape is ever-changing, and it can be challenging to navigate. Warren Buffett's time-tested strategies offer valuable guidance. His approach has been honed over decades of experience and success. One of his most important pieces of advice is to invest in what you know. This means focusing on industries and companies you are familiar with. Focus on companies you understand and believe in, those with a strong track record of profitability and a durable competitive advantage. These companies are more likely to weather economic storms. Buffett also stresses the importance of taking a long-term perspective. Patience is key in investing. Market downturns are inevitable, but they are also temporary. The market has always recovered over time. By riding out the storm and staying focused on your long-term goals, you can avoid making emotional decisions that could harm your portfolio. Emotional decisions often lead to poor investment choices. Another key strategy is diversification. This is a fundamental principle in risk management. Don't put all your eggs in one basket. Diversifying your investments can protect you from significant losses. Instead, spread your investments across different asset classes, such as stocks, bonds, real estate, and commodities. This approach helps balance risk and reward. This will help mitigate your risk and protect your portfolio from significant losses in any one area. Diversification is a cornerstone of a resilient investment strategy. Section 6. Demystifying finance, making sense of market jargon. The world of finance can be intimidating, filled with complex jargon and confusing terminology. But understanding the basics is essential for making informed investment decisions. Let's break down some key terms. Stock market, a marketplace where shares of publicly traded companies are bought and sold. Index, a basket of stocks that represents a particular market or sector, such as the S&P 500 or the NASDAQ 100. Diversification, spreading your investments across different asset classes to reduce risk. Risk tolerance, your ability to withstand fluctuations in the value of your investments. By understanding these basic terms, you can start to make sense of financial news and market commentary. Don't be afraid to ask questions and seek out resources that can help you expand your financial literacy. Section 7. Your action plan, protecting your investments today. Now that you understand the risks and the potential strategies for mitigating them, it's time to take action. Here are some practical steps you can take today to protect your investments. 1. Review your portfolio. Assess your current asset allocation and ensure it aligns with your risk tolerance and financial goals. 2. Rebalance if necessary. If your portfolio has become overweighted in certain areas, consider rebalancing to maintain your desired asset allocation. 3. Consider a cash reserve. Having a cash cushion can provide peace of mind and allow you to take advantage of buying opportunities during a market downturn. Remember, these are just general guidelines, and it's essential to consult with a qualified financial advisor to develop a personalized investment plan that meets your specific needs and circumstances. Section 8. The time to act is now, safeguarding your financial future. The possibility of a market crash may seem daunting, but it's crucial to remember that knowledge is power. By understanding the risks, heeding the warnings, and taking proactive steps, you can protect your investments and navigate the turbulent waters ahead. Don't wait for the storm to hit before you act. Take the time to review your financial situation, assess your risk tolerance, and develop a plan to safeguard your financial future. Remember, the best time to prepare for a storm is before it arrives. Your financial well-being is too important to leave to chance. Take control today and ensure you're prepared for whatever the market may bring.